Part 2. Did Signature die suddenly during the chaos? This is long. Let's see. So let's get through this. We're going to go through some bullet points. We get the idea. If the demise of these banks can be analogized to a murder mystery, Silvergate was killed slowly and covertly with poison while Signature was shot in the street in broad daylight. On Sunday, the 12th of March, Signature was abruptly sent into the FDIC receivership by the NYDFS. This was not a 2-bit crypto bank. They had $110 billion in deposits as of year-end 2022, of which around 20% came from crypto-focused companies. They also administered popular Signet product, which similarly to Silvergate's SEN, allowed for crypto firms in their network to settle up fiat transfers 24/7, 365. Because blockchains are running and churning all the time, relying on legacy banking hours for fiat settlement causes problems, particularly with liquidity to exchanges and stablecoins on the weekend. Especially after the demise of Silvergate, Signet was positioned to benefit as critical crypto infrastructure. On Sunday night, Signet, along with the rest of Signature, was abruptly delivered into the hands of the federal government. Almost immediately, we knew something was wrong. Signature was not a crypto bank like Silvergate, where the majority of deposits were derived from crypto firms. It was pretty venerable, a pretty venerable New York bank that primarily serviced real estate. It was not in as bleak a financial position as Silvergate or SVB or other I can never pronounce this word, regional banks. They weren't closed on a Friday afternoon after market close, as is typical in receivership situations, but snuck in on Sunday night, practically a footnote to the SVB shutdown. The FDIC was reportedly surprised on Sunday when SBNY was delivered into their hands. The NYDFS has maintained a well-known, long-running animus against crypto. The banking crisis was the perfect cover to take down the last remaining bank, which was unapologetic about serving crypto firms and ran important fiat settlement infrastructure. The only problem, based on what we know, it appears that Signature wasn't actually insolvent when they were nationalized, and $4.3 billion of shareholder value was vaporized. The crypto industry soon found an unlikely ally in Barney Frank, the former chair of the House Financial Services Committee and the Frank in Dodd-Frank. Mr. Frank served on the board of Signature and had as keen an insight into their finances as anyone. Immediately, he alleged that Signature could have opened Monday and that the leadership was shocked when they were put into receivership. This shocked crypto folks, including myself, who immediately suspected foul play. Frank would later elaborate on his claims in a blockbuster interview with New York Magazine's Jen Weisner. His comments leave absolutely no doubt that the closure was a political hit job primarily motivated by a desire to send a message to the crypto industry. In the interview, he said the following: DFS never actually said that Signature was insolvent. Despite pending outflow, Signature would have been operational Monday. DFS overreacted to SBNY's inability to give them sufficient data. DFS doesn't want banks doing crypto, and SBNY was closed to instill fear in others. Which is what's happening, right? Like, that's what we're seeing is a lot of this is fear-based. I mean, we've been seeing it surrounding cryptocurrency for a while. There is like this narrative that it's the highly volatile and etc. And that's what gets pushed over and over again because it's a threat, right? And Barney Frank is by no means a crypto booster. He has described himself as a skeptic, so his testimony cannot be motivated by a desire to paint the crypto industry in a positive light. The Wall Street Journal editorial board, normally circumspect about crypto, found Mr. Frank's statement sufficiently concerning to write 2 follow-up editorials. As more data emerged, even the taciturn Wall Street Journal, even the Wall Street Journal became convinced that Signature was a political execution. NYDFS pushed back, saying they had suffered a crisis of confidence in SBNY's leadership and that they weren't provided with sufficient data in a timely fashion during the crisis. However, neither confidence nor data are acceptable reasons to expropriate a solvent bank. especially when other banks in similar position were given time to save themselves and access the Fed's new BTFP facility. New York banking law is extremely broad with regards to conditions under which banks can be seized by the superintendent. When challenged, New York will likely argue that conditions C or H in Banking Law 606 apply, namely that SBNY was in an unsound or unsafe condition or had refused to submit its records and affairs to inspection. Despite the vagueness justifying the seizure of a solvent bank, something virtually unprecedented in U.S. financial history, will be a high bar to clear. Signature wasn't in particularly precarious position when it came to their held-to-maturity portfolio, which was the issue with SVB. In a note on Sunday morning in the wake of the SVB failure, Piper Sandler said that their balance sheet looked fine. Their ratio of unrealized losses to common equity Tier 1 capital before they were shuttered was just shy of 40%, in line with Wells Fargo and PacWest, and lower than that of First Republic, Commercia Incorporated, Fifth Third Bancorp, Huntington, so on. In particular, the disparate treatment given to Signature versus their peers, PacWest or First Republic, is extremely telling. Both banks were in similar or worse financial positions, yet both were given time to save themselves, whereas Signature was seized on Sunday night right after SVB's collapse. First Republic was given time to raise after the SVB collapsed and secured a $30 billion lifeline. However, their stock is down 87% in the last 2 weeks, and they still appear likely to fail or be acquired. Clearly, they are in a financial position as bad or worse than Signature, yet they have been given plenty of time to sort things out. A banker familiar with the financials of both banks told me First Republic, it was a double standard compared to Signature, zero doubt in my mind. Here's what's interesting about all of this. As we saw all of this happen, we saw the price of Bitcoin go up. And we've talked about Bitcoin kind of being a Trojan horse. And it's like, what is the quote? I think it's like, if you cast stones at me, they will turn at fire and demolish you. Like they'll come back at you. And it kind of feels like that's what crypto is doing. It's really interesting. Subsequent developments with the Signet and Signature's crypto business all but confirmed our suspicions. Reuters reported on March 16th that Signature, if sold, would have to exclude their crypto business, according to 2 sources. This was later denied by the FDIC, but lo and behold, when the FDIC announced on Sunday, March 19th, that Signature would be acquired by the New York Community Bank Corp's NYCB Flagstar Bank, the crypto business was not included. There could perhaps be a benign interpretation, such as NYCB's involvement in Figure's provenance blockchain, which they might have seen as competitive with Signet. However, the overall crypto business and the Signet IP is undeniably worth something, and the FDIC's duty under law is to maximize the value of the entity being sold. This week, I heard from crypto clients of SBNY that they were given 24 hours to withdraw their remaining deposits. Post-run, there were still $4 billion worth of crypto-related funds at the bank. Purging those deposits is not a move made by a bank that intends to maximize value of their established depository base. If Signature is sold to NYCB and Signet is shuttered entirely, and none of their crypto relationships are ultimately acquired, the denials by the FDIC of anti-crypto motive will look quite hollow. There is surely more to come, but for now it appears that Signature's entire crypto business has been squashed or quashed by the government mandate. If the FDIC indeed strips Signature of its crypto business, once accounting for around 20% of their depository base, they are surely not maximizing the value for taxpayers, and stern questions must be asked.
Established in 2017, Octominer is an international mining hardware company. They manufacture and engineer the best mining equipment in the industry and supply rigs to some of the largest mining farms around the world. Their GPU mining rigs also integrate with the top crypto operating systems like HiveOS, MinerStat, and Simple Mining. All parts come with an international 1-year warranty. Exciting news! They will be adding ASIC miners for sale to their website soon and launching a new product built specifically for ASIC home miners. Please visit octominer.com or email support@octominer.com for questions.
So this is the last part, surveying the wreckage. I did end up reading this entire thing primarily because I think this is extremely important, and I'm doing this to understand this myself as well. Because wow, just wow, right? Like, it's a lot to parse out, and you have to take everything with a grain of salt because this is clearly written by somebody that, you know, is for Bitcoin, for cryptocurrency in general. You know, so just keep that in mind while we go through it. The 2023 banking crisis has truly exposed the inherent instability in our financial system, which is always funny, right? Like, now we have this instability, but they still want to go out there, you know, like we were seeing with this release, right? And be like, oh, cryptocurrency is extremely volatile. And it's like, what about everything else? Because that seems extremely volatile right now as well, right? Any bank would struggle to survive massively whipsawing interest rates. Depositors can't be blamed for fleeing to safer havens. The fiat-only system has rewarded us with the second major financial crisis in our lifetimes, which will yet again require trillions in bailouts. The system in existence since we severed the tether to gold in 1971 has been a rank failure. And it's no surprise that Bitcoin has found a renewed vigor throughout this latest financial crisis, which of course it has, right? We should not see Bitcoin at 28,000 right now. It should be still between 18,000 and 23,000 based on the cost to mint a Bitcoin. The fact that Bitcoin is at 28,000 right now and keeps touching that is extremely telling. And it's going to be interesting to see what happens when it actually halves in 2024. The value proposition of Bitcoin, excuse me, an asset which is no one's liability and can be truly owned and held in an individual self-custody, has never been more evident. Many in the crypto space see Bitcoin's recent price performance juxtaposed against that of risk assets or financial indices as validation of the thesis, which is what we've been talking about. It's kind of like, this was what it was created for, so is it going to work? That's kind of, this is the test phase, right? It's amazing. However, the effective decapitation of the pro-crypto bank sector has caused real problems. Silvergate's SEN and Signature's Signet were essential infrastructure powering 24/7, $365 clearing for crypto firms. Those are now effectively offline or unusable. Because blockchains settle without interruption, frictions emerge when they intersect with 9-to-5 world of banking. Stablecoins may have trouble keeping their pegs on the weekend. Market makers and exchanges can't settle with each other as easily. Expect liquidity to suffer as a result. Now, in my humble opinion, if I see stable coins go away, boohoo, wow, I'm good with us going back to Bitcoin as the standard for crypto, right? We talked about this just earlier in the show. A couple steps back, but it's going to be better for the future of crypto. Crypto firms that need banking have a harder time than ever. I can personally attest from our own experiences in the last 2 weeks at Castle Island that many banks have simply adopted a no crypto rule. Others demand a certain threshold of assets to overcome the crypto prohibition, or insist that crypto only account for a small portion of your revenue or source of wealth. There are a dozen or so onshore banks that have stepped up to fill the gap. However, their names are whispered and circulated in private chats among investors and founders. Everyone knows that any bank that emerges as a leader in the crypto space will risk the same fate that befell Silvergate and Signature. So, the few banks that are brave enough to bank crypto firms operate in secrecy. And due to this artificial 15% threshold on crypto deposits imposed by the FDIC, no bank can ever recreate the network effect of SEN or Signet. Unless a large bank steps in, and none have so far, a competitor with a crypto book simply can't onboard enough crypto clients to create a strong network around real-time fiat settlements. Based on the dozens of conversations I've had with bankers and service crypto clients, the atmosphere is one of abject terror. Crypto firms getting denial after denial from these banks is bad enough, but within them, the regulators have cultivated a horrific environment. Everyone has seen what happened to Silvergate and Signature. They understand that they could be shut down or seized at the faintest hint of trouble, even if solvent. Certain banks that serve crypto clients tell me they are getting daily calls from the FDIC demanding lists of crypto clients, pressuring the bank to unbank them. We all knew this was coming, though. That's the thing. It's like, this has to happen. So, like, to get really upset about it is kind of like, I mean, what do you expect in a transformation to digital currency to happen, right? Like, you think that that's just going to peacefully go down? There's not going to be any pushback? No, of course there's going to be pushback. It's too much money at play. It's too much power at play, really. It's not even about money, it's about power. Banks are now being told to individually run all new crypto businesses or business by the FDIC before they do any onboardings. Many of these bankers want to help these potential crypto clients, but because of these verbally messaged 15% thresholds, which could well shrink to zero, they can only allocate a certain ratio of their deposits to the industry. So they have to pick and choose the firms they are able to support. This causes a Goldilocks issue whereby banks must prioritize medium to large clients, not too big as to breach the threshold, but not too small as to make the additional cost of burden not worth it. Financial considerations mean that smaller crypto clients are left in the cold. Most worryingly, the takedowns of Silvergate and Signature represent a rank lawlessness associated with authoritarian regimes. In a lawful society, solvent banks are not seized by the government simply because their clientele is politically disfavored. Shareholders in Signature had $4.3 billion in equity, $22 billion at peak, wiped out with no recourse. This is a confiscation that you might expect from the CCP, not the NYDFS. The U.S. has already put the world on notice by weaponizing the treasury market with their seizure of Russian reserves. It's no secret that foreigners are divesting as a consequence and trying to reduce their exposure to the dollar and the dollar settlement system. We've been talking about this, guys. And a lot of people, I saw a couple replies, when on the El Salvador thing, I said, maybe it's time for a new home. And then you get like the I don't know, the patriots get all mad and they're like, fine, leave. I'm like, I don't think you understand. The problem is that I want the U.S. to adopt this, and I would love to see the U.S. be the leader in cryptocurrency. But what we are seeing actually take place is an authoritarian regime surrounding the banking system. Right? That's what's happening. The dollar's preeminence globally, long considered unimpeachable, is fraying as Russia, China, and the Saudis look to settle in alternative currencies. The U.S. can ill afford to sow mistrust in its own banking system. The public deserves answers to why an apparently solvent and functional $100 billion bank was seized on a Sunday night with no notice. Lame excuses like insufficient data or a crisis of confidence in leadership are nowhere near sufficient explanations to justify the third largest bank closure in U.S. history. DFS additionally questioned SBNY's ability to do business in a safe and sound manner on Monday. Of course, this is a bit of a catch-22, as all crypto-focused banking has been derided repeatedly by bank regulators as incompatible with bank safety and soundness. As I covered in my prior note, and as was elucidated in congressional testimony by former OCC Chief Counsel Jonathan Gould, if you declare a certain type of business incompatible with bank safety and soundness, and then close the bank on a soundness basis, it's just a long-winded way of saying this particular legal industry is banned. Real answers must be sought. Those paying attention in the crypto space are scandalized, but have largely failed to react. As of yet, no meaningful pushback has materialized, with the exception of from Whip Emmer, who accused the FDIC of weaponizing recent instability in the banking sector to purge legal crypto activity from the U.S. Former Comptroller Brian Brooks also alleged that bank regulators were using the crisis to choke off crypto-focused banks. What must happen here is an honest investigation into the causes of bank crises, and in particular, the role that federal regulators and members of Congress played. Crucially, the public deserves to know whether Signature Bank was arbitrarily seized during the fog of war to advance a political agenda. Shareholders who saw their equity wrongly vaporized should sue under New York law, and clients of the banks who suffered business impairments on account of rapid forced withdrawals and general unwillingness of other banks to support them, or the closure of SEN or Signet, also have a case here. To the FDIC and OCC, I would ask the following. And then he goes through the questions. Either way, in my humble opinion, like, this is kind of expected, and we'll have to see where it plays out, right? Or how it plays out. For protection of yourself, if you want to participate within cryptocurrency, it's highly advisable that you do control your own keys. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.